All right. Well, thank you all very much. I appreciate this opportunity to be here, and I thank Investor Inspiration for the next 45 minutes or so to take you through sort of my journey and some things I've learned along the way. Now, I know it's after lunch, depending upon where you are, and that can be a tough slot to speak to folks and share thoughts, but I do encourage you just to sit back, relax, put your feet up. I'm not going to ask you for a thing. There's no sales pitch. It's not my style. I believe in educating is the best selling I can do, and the best education I can provide is by actually sharing what I've learned from executing over 2,000 trades over the past almost 10 years now. So I do appreciate this opportunity, and just relax. In fact, the only thing you do need to remember that I'll ask you to consider doing, if you want a copy of these slides, you can get them at this URL down below, investorquant.com/investor inspiration. investorquant.com/investor inspiration. You can get the slides. I've also got my ebook, Understanding Gaps. I'm not going to be talking, and this is an unusual presentation. I've only done it one other time, and I did it live, but I thought it would be interesting for this group because there's so many ways to make money in the markets, and some of them are being taught today. There's an even greater number of ways to lose money in the markets, and some of those might be taught today too. I'm not sure, but I'm going to stay away from techniques. I teach other webinars and people how to do that. Again, I thought what would be most valuable is actually to sort of take into what I've learned in the trenches of actually executing live money trades week in and week out consistently for more than a decade. Normally I share quite a bit of research that supports everything I say. I'm a big believer in not taking my word for it, but encourage you to trust but verify. And one of the ways I help you do that is I actually show quantified research that guides all of my decision making. And today's going to be a little bit more conceptual, so it's going to be a little bit more different. Again, we'll not focus on a technique, but I think you're actually going to get a lot more value out of me sharing some of the do's and don'ts and things that have worked for me, because this game is ultimately way more than having a technique that works for capturing a profit in the markets. Anybody can make money when a strategy or technique is working. A monkey could do it, honestly. But it's a lot harder when they don't work, and they don't all work all the time. Nothing works all the time, period. So the key is to arm yourself with the mental skills, the emotional skills to endure those tough sideways periods and drawdowns. Drawdown being when your account actually goes the opposite way that you're trying to get it to go. And again, it's every technique, every strategy has to endure drawdowns. The key is to make sure you're prepared for them. So again, if you want to copy these slides, go to investorquant.com/investor inspiration. You can also get my book. It's about 60 pages. Actually sold out. I had 5,000 copies sold out about 7 or 8 years ago. Takes you into my favorite setup, which is the opening gap. Fantastic technique. I fade the opening gap. I've got the sort of funny nickname of the gap guy. I've probably done more research than any individual will ever meet or hear from regarding the opening gap. It's my bread and butter. I'm very quantitative and mathematically oriented. Even though today's presentation is not going to be very focused in that regard, it's going to be at a little bit higher level. So don't worry, not going to have any hard math for you here. But again, if you want a copy of the book for free, just go to Investor Inspiration at the end of investorquant.com. So I'm going to tell you a little bit about my journey. Try to keep it short and not make it too long-winded. Share 4 things I believe you must know, certainly 4 things I must know before I place a trade. 7 things I learned the hard way that you won't hear a lot of people talk about. I'll give you a tip on how to trade large accounts. There is a difference between trading smaller accounts and larger accounts. And I'll share my results both year to date and over those last 2,000 trades. All right, so why should you listen to me? Well, first, I can tell you I'm not nearly as articulate and high energy and eloquent as the prior speaker. That's not my style. I'm not a professional sales pro. I'm not a professional presenter. I wouldn't even call myself a professional educator, even though I have been educating other traders and real-world investors for a long time. You see a couple of funny comments there. You know, I've been highly educated myself. But none of that really matters, right? I mean, really think about it. Is there anything on my resume there? Going to West Point, MBA from UNC, I was an Army officer, helicopter pilot, have a big house, made a bunch of money trading. Is anything there that really is worthy and justifiable for you to follow me and listen to me today? And I would argue, no. Probably not what you're expecting. There are plenty smarter people out there. There are plenty of people that are better presenters, but none of that makes you, there are plenty of people who have been educating longer than I have, but none of that in my mind really stands up to live trading. And that's something I've done in my own account for more than a decade. So what you're seeing here are over 2,000 trades, and 95% of the trades I've executed in almost 10 years since I started a blog back in the fall of 2007, right before the market crash of 2007. Little did I know, I actually survived and thrived because the techniques that I do trade tend to take advantage of volatility, so they do really well. You see the volatility has been high, was high in 2007, 2008, and then this year they've been high too, so it's been a great year. So the real message here is that it's not the fact that my account has grown. It doesn't even matter how much it has grown, but the fact that I've had to endure sideways periods, these little pull downs or sideways periods. These are called drawdowns. Everyone has them. Nobody likes to talk about them, except for maybe me, because I think this is where the magic is made. Learning how to navigate your own emotional roadmap, if you will, to navigate your own emotions, your deal with your own self-esteem issues you may have if you tie too closely to trading, dealing with your own self-confidence, your confidence in your strategy, your confidence in the markets, managing all of the complexities of life. I had 2 surgeries in here at this time, right in the middle of this, 2 back surgeries, which that's a story for another day. That is what makes me someone worthwhile listening to, I think. So hopefully you'll get some nuggets out of this. That's my goal, regardless of what you trade. I trade futures. It doesn't matter what you trade. I think I'm going to share some nuggets that will make you a better trader. Big account, small account, futures, forex, commodity stocks, and so on. I got a question already. Is the GAPS ebook also good for forex? Well, there's really not much of a gap in forex. Now, technically, there's not much of a gap in futures either, right? Forex, you get the once a week. A weekend gap, if you will, and I use futures trade mostly 24/7, but I use essentially it's a synthetic gap, meaning I create a gap on my charts by ignoring the overnight action and only looking where the volume kicked in. Again, I'll show you how you can learn more about gaps. In fact, my book is the best thing to probably read to learn about that. All right, so real quickly, I'm a fortunate and somewhat unique individual. I was actually able to take a company public that I created in my dining room with my wife and 3 childhood friends, or 2 childhood friends and a close, very close personal friend back in 1999. We took it public, started in 1995, and right place, right time, and we had a real product and a real service selling e-procurement and materials management solutions over the internet to pharmaceutical and life science companies. The company was called SciQuest. It was a crazy, crazy ride, and stock ran all the way up, and then we crashed like everyone else did in the dot-com meltdown. But we survived, and I'm extremely proud of that. I stepped down as CEO when we transitioned to a pure software company, and I started trading on the side. I helped stay on for 2 years, stayed on the board of directors, and during that time I really thought I'd step into a traditional job. I was only 35 years old maybe at that time when I left the company, and I thought I would just take over another small entrepreneurial company. But I'd had some amazing success along the way. Trading, not knowing what I was doing, but I had spent some money with another educator, spent about $20,000 learning how to actively swing trade the markets using options. And there was a pretty conservative strategy using covered calls. And if you go back and look at the charts in 2003, the markets went pretty much straight up. And just about any monkey could make money. I didn't realize that I was one of those monkeys. In fact, I thought I had a gift, and I didn't. The markets turned sideways. They didn't really even go down in 2004. They just stopped going straight up, and all of a sudden, all the money and time and effort I spent learning this new technique stopped working. And the educator swore it was me, and I promise you, I am a lot of things, but I am not lacking in discipline. And I had followed his rules, which he had promised, told me exactly what to do, and I'd sat side by side with him to a T. And guess what? They stopped working. And he wouldn't admit it. And then I lost confidence in him, and I really sort of lost confidence in anyone teaching anything because I'd really done my homework on them, and decided that I did have a natural inclination and skill set for trading the markets. I'm disciplined. I'm mathematically oriented, and surely there had to be some way to trade the markets that would work for me. So I started crunching data that I downloaded from Yahoo Finance, believe it or not. I downloaded the diamonds, open, high, low, and close, right, the 4 levels each day, put them in an Excel spreadsheet, and spent 3 or 4 months analyzing that data with pivot tables in every way I could, trying to find an angle. I stumbled on the fact that opening gaps fill about 70% of the time. Wherever a market opens, at least any index-based market or any large stock in the U.S. or even in Europe or anywhere overseas, they tend to revert back to the prior day's close 7 times out of 10. So I was, with that little piece of information, which I'm sure the rest of Wall Street knew, I just didn't, I started breaking it down further, and I started identifying in what scenarios, which types of gaps were most likely to fill that day. And I would fade the open. I'd trade the opposite direction of the gap. And I literally had success in the first 6 months that was just almost too good to be true. Start trading it with real money, and the rest is sort of history. I developed a following, and sharing my thoughts and ideas in another individual's trading room or another company's trading room, and developed a following. That's where I got the corny nickname, the Gap Guy. And about 3 or 4 years later, I was encouraged to start a blog and started sharing my research there. I put a PayPal button on it, and it just sort of took off. And since then, I've evolved an awful lot. I'm going to share what I've learned. I'm not going to talk really about the company or what we do at InvestaQuant. You can come learn more if interested, in a webinar I've got next week, which I'll share at the very end of this presentation. But it's been a pretty fascinating ride. So let me tell you sort of where I've started and how I've evolved. So early on, I thought, well, I wanted to be a stock trader. I thought I would trade options on those stocks. That was the technique I learned. I would hold them for probably weeks at a time, maybe months, maybe days. I would use charts. Everyone uses charts. And you know, I would manually execute my trades, and that's what I did, and that's what worked the first year, and I made a bunch of money. I actually doubled a 6-figure account in my first year, and I gave 98% of it exactly, or almost exactly, back in 10 weeks of the second year, because I'd increased my position size and it just stopped working. I lost confidence in the technique, I lost confidence in trading to a certain degree, but I explained, I was able to recover, and the only reason I was able to recover is I had enough time and frankly enough money to take my time and figure this stuff out. Most people don't have that luxury. This is where I started. Very common. Nothing wrong with stocks and options and this type of trading. But I want you to understand my view and what's led me here today, and it might resonate with some of you that might be struggling now. So I ended up trading indices. I found that the indices were these giant mean reverting instruments. Mean reverting meaning that the S&P 500, the NASDAQ 100, yes, sometimes they will trend in a given day, but 7 times out of 10, they revert back to the prior day's close. In individual stocks, the same applies, but it's a little trickier. You have to pick the right stocks in the right sector and so on. In fact, I found myself constantly trying to figure out if what the broader market was going to do before I would try to pick a stock and which direction. And I said, what in the world am I wasting all this time on stocks for? Let's just focus on the index. That's where the big money is anyhow. So more consistent, less risk, frankly. I didn't have to worry about some surprise earnings announcement or insider trading or something with the CEO and his girlfriend. Instrument, options, nothing wrong with options whatsoever. You do know the old joke though, right? How do you make a small fortune in trading options? Anybody know how you make a small fortune trading options? Somebody's got to know. You start with a large one, right, Rick? I wish I had something to give you. That's the old joke. There's nothing wrong with options. Many people do them, and they're fantastic instruments. I traded them. That's what I was trading for about 15 months. However, you do have a lot of things that you have to get right. Not only do you have to get the direction right, you have to get the timing right. You have to be right and right now, because otherwise you're going to get time decay on those options. You have to choose whether or not you're in the money or out of the money in terms of the strike price. There's just a number, you know, are you going to be more exotic and do some type of a spread or what have you? There's just a number of decisions that you have to do. And what I realized with futures, not only were they easier, they're perfect trading instruments, even easier than underlying stock and margin and dealing with wash sale rules and all that. They're tax advantaged. 60-40 short-term, long-term capital gains tax treatment. And it's one line on my tax return. So lots of advantages for futures. Tons of money, tons of volume, tons of liquidity. Holding period. I started off wanting to trade weeks, but I quickly realized that if I only traded 2 or 3 times a week, how was I going to possibly learn fast enough to be successful in the time frame I wanted to? I knew that mathematically there's an expression, n must, to be statistically significant, n must equal 30. That means 30 data points before you can form a statistically reliable judgment about something. Well, shoot, if I was only trading twice a month, 12 months, that's only 24 data points. That wasn't enough for me to even learn and to make adjustments. So I quickly realized I need to trade more frequently, and the good news was the shorter the time frames, the less big money I was worrying that I was trading against, if you will. I only had to sort of predict, or only had what was going to happen in the coming hours. So I was able to trade more and learn from it. So more trades, less risk, accelerated my learning curve a ton. And this is radical. Not many people do this, but I realized that the charts were sort of like a Ouija board. Now, that's not for everyone. There are plenty of masterful chart readers, no doubt about it. I do believe it takes at least 10,000 hours of time to master charts or to master anything. That's not my view. That's statistical analysis by Malcolm Gladwell that he presented in his book called Outliers. You got to be an outlier to read charts and consistently beat the markets year in and year out. That's what I believe. I know others don't believe that. That's what I believe, and that's what the hundreds of people that follow me and have for years believe as well. Charts are overrated. You need them, but they're overrated. They're very complicated. You have to be able, they're not complicated necessarily, but to interpret them properly, you have to interpret them in the context of the proper market conditions. And my view was, holy cow, how am I ever remember all these different scenarios and lining up stochastics with the MACD and so on works in this market condition, but not this one and so on. And ultimately I said, this is crazy. Use my expertise and my resources available to me and hire a developer, and let's start capturing this information and let my database tell me when the markets are set up in a way that have been profitable historically. So that's what I do now. I use robust historical analysis. I don't use discretion. I don't get wrapped up in emotion. I set up my trade and I walk away. Predetermined target, predetermined stop, period. Period, period. I'll say it again, period. Charts are overrated for most people, in my opinion. Execution, I just started going full-time automated in the past couple of years. I've traded a mechanical system for about 10 years, but my primary, those 2,000 plus trades since I became an educator, 90% of those were executed manually, meaning my research, my database would generate research that would tell me today or this opportunity at the open has a high probability and a high profit expectancy and is worth trading, and then I'd manually push the button. So here are the 4 things you must know before a trade, or maybe I should say 4 things I must know before a trade. You can choose whether or not you want to keep up with these or not, but they've worked for me, and hopefully they'll make some sense to you. And I'm going to have to power through. I have lots of nuggets I want to share here. So what is the edges history? I've already mentioned or alluded to this to a point. If you're looking at charts, you don't really know how that setup has performed historically under similar market conditions, right? You can have a double bottom, a double top, a Fibonacci, a moving average crossover, any number of technical approaches that work the majority of the time, or maybe only half the time. Maybe they don't even work the majority of the time, only certain market conditions. So the key is to know the edges history for the environment that you're trading there. And you want to analyze similar trades. You got to get them either from your broker or online. You can even print charts. That's how I started out. I printed 5-minute charts once I developed my basic gap strategy with Excel. Printed a couple of years of 5-minute charts, and I studied what happened to prices in these different scenarios. Or you can outsource some of this work to a research partner like InvestorQuant. That's essentially what we are. We're a tools provider. We do have alerts and automated strategies, but at our core, we're a research organization that provides quantified strategies. I do suggest you stop trusting your buddy. Stop trusting trading coaches, educators in general. And I want to be clear. Doesn't mean they're not trustworthy. I'm saying trust but verify, okay? Don't just accept everything that is said to you, whatever the expression is, all in one fell swoop, because you may be interpreting what they're trying to communicate improperly. That's probably a nice way of me saying it. And certainly don't consider just a few months of trades. What does that prove to you? That proves that something worked for a few months. Big deal. You're talking about trying to trade a strategy that's going to work for the rest of your life, you hope, right? An approach or a methodology will work for a long time. A few months of trades doesn't tell you anything. Even 1 year of trades really tells you nothing. Even personally, I don't trust it unless there's more than 3 years of data. I won't trade a strategy that's built on less than 5 years of data, and virtually everything I trade has at least 7 years of data, so that I have a large enough, a robust enough number of market conditions and environments that I can evaluate the technique that I'm trading. So as we like to say, if you can't quantify your edge, how do you know you have one? Or someone else can't quantify it. And I'm not talking some hypothetical over-optimized back test. I'm talking about digging in, analyzing a strategy many different ways, not just a single system analysis, but a robust, thorough analysis of your edge. If you can't quantify it in some form or fashion, and you can't see it, and see an equity curve and accounting for slippage and commissions and still know that it's made money, then you should not be trading. Why are you going to risk your hard-earned capital without knowing for sure? I think it's sort of crazy, but I am biased. So part of identifying or quantifying that edge is, again, looking at it from multiple angles. How is it done under a similar trend environment? How is it done with similar momentum in the market, similar volatility, when we've been overbought or oversold? How has it worked this part of the month historically, this part of the year, this day of the week? That's what I mean by looking at multiple angles. I use multiple systems to evaluate every single setup, and I won't trade using just one system and one simple view that doesn't consider many different angles. How has the edge performed under similar market conditions? I think I've made that point clear. Yeah, maybe your strategy only works on rainy days. Tongue-in-cheek here with the picture, right? But I think you get the idea. Some strategies work better in raging bull markets. Some work better in raging bear markets. Some work better when the markets are going sideways. But I can tell you for an absolute fact, I've never seen, and I've studied over 1,000 of these things from everything I've been able to get my hands on. I've got developers that code and test these things. We have not found a single technique that has worked year in and year out through, we consider there are at least 4 core market phases. There's really more than that. But we've never even found one that worked on all 4. Not one. So if you don't know which market environment your strategy works best in, you can't see the quantified historical results, even if they're hypothetical, at least something, to be really, really careful. And then lastly, it doesn't matter what I think the optimal way for most people to trade is. It only matters if it would work for you. And that applies to any technique, any approach that you're considering or that you're doing. It's got to fit your lifestyle. It's got to fit your background, your experience, your interest level. If you're just not a numbers person, I was going to say you ought to stick with charts, but honestly, if you're not a numbers person, you shouldn't be trading, right? So a lot of different ways to make money, more ways to lose money, but it is possible to trade a strategy that really doesn't suit your lifestyle, your time frame, your risk tolerance, and so on, and lose money because it doesn't fit. All right, here's 7 things I learned the hard way. I'm going to have to power through. I've only got about 12 minutes left. Hopefully I can go a few minutes over like the guy in front of me, but I'm going to be prepared to wrap up. 1, choose the best setups and then diversify with care. So it's sort of like I was in the Army for 5 years. We had Special Forces, Delta Force, and so on. We were trained as just even classic infantrymen at West Point. You want to spread out in enemy territory, right? You want to have a diverse team. You want to have somebody that's carrying the 60 and another guy's got the ammo and the comm and so on. You want to make sure that a single shot or a single grenade is not going to blow you up. Well, same thing with trading. If you're part of that military analogy, it works really well here. That's what the smart traders do. No single day, no single strategy, no single trade is going to destroy my week, month, or year. Even day, really. But I don't really measure on a year-to-year basis. So the key is to diversify carefully. Stick to your trading plan. Everyone says self-discipline is essential. Self-discipline, I will tell you, can destroy your account if you were trading a strategy without an edge. So I do put a giant asterisk on this slide. being disciplined, following a strategy that doesn't have an edge is the fast path to destroying your financial or emotional capital. So but you do, once you have a plan with an edge you've quantified and you can prove and you know exists, you do have to be extremely disciplined. Any on-the-fly judgments you think are going to make this trade better, trying to pick a better target or better stop than what you originally planned, doesn't work most of the time. It works sometimes. That's what fools you. The problem is every time you track your results, most people can't do it. It takes years and years, thousands of hours. Here's the one that no one ever wants to show you or talk about. That in red is the amount of time, and to a degree these were, I'm not sure these are percentages of dollars, but that I was in drawdowns. The green periods were when I was in a run-up, meaning my account was higher than it was the prior day. I was putting in new equity highs. The rest of the time I was sideways or down. People don't think about it. Most of the, and this is absolutely the way trading works. Promise. I'm not 99% right. I'm 100% right. Okay? There is nothing that works all the time. So when your account is not sitting at its all-time equity high, by definition, you're in a drawdown. So you have one losing trade after you put in a new high, you're now in a drawdown. And those drawdowns tend to last longer and go deeper than people ever want to talk about. So get your scuba gear ready. Protect and preserve your financial and emotional capital. It's not just about your financial capital, it's your emotional capital. That's what keeps you in the game. The best way to make the most money over the long term is to stay in the game over the long term. And yeah, a lot of people with small accounts blow them up because they trade too aggressively, trusting but not verifying a technique before they start throwing money at it, and they blow up a $10,000, $20,000, $30,000 account. Most people can recover from that eventually. But what most people don't consider is the importance of emotional capital, the self-confidence, the desire to get up and do the hard work that it takes to be a successful trader. So you want to balance that. Focus on the horizon. This is another huge mistake. Most people come in and they go say, okay, if I would just be a trader and follow that technique that I read about or saw online or saw on YouTube or saw that guy present, that'll solve my problems. He says it's guaranteed, right? There's no way I can lose. Well, guess what? There's always a way you can lose. Not only can, most people do. That's the fact of the short-term trading. If you take a short-term focus, and more importantly, you have to make money or you're counting on making money, your risk tolerance is very low, the odds of you making money are extraordinarily low. And I know what I'm saying is not popular and maybe doesn't jive with other speakers. I'm just telling you my own beliefs from my own experience, having done this a really long time. So the name of that doesn't mean you don't trade. It just means keep your expectations in check. Slow down, back up, look at the big picture, and do the following. Ask yourself, what would happen if I took my current trading capital, my account, and I just grew it 15, 20% a year, which are tremendous returns if you can do that consistently, by the way, and you can, without taking some crazy risk. If you could compound your money 10, 15, 20% a year and do that for the rest of your life, wow, what would that be a life changer? But most people get too focused on trying to double their accounts. I've doubled accounts, significant accounts in 1 year. You can do it. But I was also willing to lose the majority of that account in terms of the drawdown. Most people can't handle that. So, and I don't recommend that. I don't trade that way, that aggressively anymore. I used to dabble around with it. It just, the name of the game is consistency. And working backwards from take how much risk you can handle. That determines how much money you can make in a given year. Focus on the horizon, measure results over the long term. Every 6 months, every quarter at most. And actually, I tell most people just focus year to year. That'll keep your head in the game. Look for trading edges at extremes. So another, since I'm not really talking much about techniques here, we trade intraday, overnight, and swing trading. We found the best edges, the ones that are most predictable, is when the markets get in extreme states. And they tend to happen, well, at the extremes. When the markets are overbought or oversold on a certain time frame, when we've had a big expansion of volatility or a big contraction of volatility, any number of ways. But it's at the extremes. So guess what? Past couple months have been very difficult trading in the stock markets and here in the U.S. and the equity indices. Market hasn't gone anywhere. Tightest range, I've heard people say, from 40 to 100 years. The markets just aren't moving. You can get chopped up. Fortunately for me, if you create your strategies, they trade only when the markets are moving. So I don't get many strategies, many signals when the market's quiet and directionless. And that's okay, because I'm not trying to make money each day or each week, because I know that's foolish. That's unrealistic. The name of the game is to trade your edge whenever it appears. If it's not there, don't trade. And lastly, trade with history on your side. I've tried many a time to force my will on the markets by trading a technique that I had utter confidence in. It was an indicator-based technique is the one that's coming to mind. Some of you probably heard of a squeeze. It's like a Keltner channel breakout from Bollinger Bands. It might be the opposite of that. Anyhow, many people just call it the squeeze. Fantastic indicator. Works about 50% of the time. It's all about the market condition. It's all about the market condition. So if you don't trade when historically the market is set up with a directional bias, or if you don't trade when it's set up in your favor and you're trading against it, you're going to get hammered. And this is a simple strategy that all based upon whether or not historically there's been a 10-year edge or not. Trading against it, you would have lost a ton of money. I only have 38% win rate on trading the gap. Anytime you were trading against market conditions that were favorable for gap trading, you get destroyed. Hundreds of trades, lose a ton of money, but most people don't even have a clue. So the key here is make sure you're trading with history on your side. And you get that from going back and studying your edges, right? So these numbers are representative, not representative, they are my actual year-to-date results for my tracking account. That's an account that trades the opening gap and the opening ranges using only our research and rules at InvestiQuant. I use absolutely no discretion whatsoever. None. So I don't have to think. When it meets my rules, I'll place a trade. And that's trading one contract per $10,000. This futures account has a $100,000 account. So I'm not trying to show off leverage or anything, but even with incredibly modest leverage, it's up about 17% year to date. With reasonable leverage, which most people would do, probably trade something a little more aggressive than this, could easily be up double or triple. But it's really up to you. And I'm not trying to hit home runs every year because I think that's a quick way to strike out. Profit factors made about 40% more in profits. It's 300 and some trades. This is about 10, 12 strategies. We actually have about 15 right now. We're getting ready to add a whole bunch of them that we've been working on. It has a positive trade expectancy. Real money, live trades. This did not come out of a back test. This is right out of my brokerage statement. So here's some tips for trading large accounts. If you have a large, because I promised that at the beginning, couple concepts before I wrap it up. Use notional funding. That means you don't have to open a giant account at a futures brokerage. Open a small one and then just trade it as if it were a large account, keeping your powder dry, if you will, in your checking account if you want, or some interest-bearing, well, there's not many of those, interest-bearing account. Or even something that's somewhat liquid that you can, if you get a drawdown, need to add capital, you can. But it's a great way to get the returns of a bigger account without risking all those funds. Focus on percentages, not dollar amounts. If you're trading a 6-figure account, I can tell you, or 7 figures, it's hard when you are up the price of your last car or you're down the price of your last car in a given trade. Can't look at it that way. You can't think in that regard. Think in terms of percentages only. You want to increase position size systematically. That means as your edge performs, you want to systematically add contracts to it. But if it's not performing, you don't. You actually want to reduce your position size. What you shouldn't do is try to time either one. It's just too hard because most of the time your human nature is going to say, okay, I want to, man, this strategy is rocking. I'm going to go ahead and add a bunch of contracts here. And that's just a big mistake because you're right. That's right before your next drawdown. Speaking of which, I believe in reducing my leverage as I get into a drawdown. So if you've been using a big shovel, digging a hole, and the hole's getting bigger and bigger, switch to a smaller shovel. It won't get as deep as fast. And then once the strategy starts working again, get that big shovel going again so that you start trading with normal position size so you can get back to a new equity high. And the last but not least, way too many people trade large accounts. I work with many of them. I've done it for years, and they're trading manually. And I told you I did a long time because I'm sort of wanted that control, but it's cost me a lot of money in retrospect. Find an edge, risk a little bit of capital, and actually find multiple edges and automate the execution of those trades, and let technology work for you, and don't be tied to your computer every minute of the day. I set up my trades, and in fact, I don't even set them up. They're all automated now. Just make sure everything's turned on. And a lot of our clients do the same thing, or you can manually execute them, but take some babysitting. So if you want to learn more, I've got 2 webinars on Wednesday, September 14th. One is for you trader types that are really committed to being an active trader. You can, if you're an experienced trader, I suggest you consider a platform, and I'll demonstrate that for you. If you're sort of a new trader and you're looking to diversify and want to try something, maybe we're in a tight budget, then you can actually access our alerts, which this doesn't say alerts, but we'll be talking about a platform and our alerts for taking advantage of our trading edges, basically signals that are quantified that have an edge that you can trade. And these are all strategies I'm trading with my own capital. And the evening webinar, or the one after that, is going to be about auto trading, if you're more interested in just sort of hands-free and worry-free. Again, you can, we'll send you information about these webinars. You can get a copy of the slides, and you can get a copy of my book, which is normally $30. Just by going to investorquant.com/investor inspiration. I got time for maybe one quick question. Since I don't use charts, I trade based off a checklist of some sort. Essentially, yes, Rick. That's the great thing, that you've got to have some rules for trading. So I'm a rules-based trader. I've automated those rules now, but yes, I want to see that historically it's had a win rate of at least 60% most of the time. I want to see that it's made at least 20-25% more in profits historically. I want to see that I've got multiple systems and multiple market condition data points that are supportive of the trade. Great question, thank you. Again, I'm not sure of my time because I got started about 10 minutes late, but I know that I was supposed to be done around 1:45. Any other questions? I'm happy to answer as long as Renee gives me another minute or two.
Yep, you can answer a few more questions. You're fine.
Great. Thank you, Renee. What is the definition of a gap? A gap is the difference between the prior day's close and today's opening price. So in the stock market here in the U.S., New York Stock Exchange opens at 9:30. So it's wherever a stock or an index is trading at 9:30 Eastern Time relative to where it was trading at 4 or 4:15 Eastern Time the prior day when it closed. So the markets, global markets tend to move overnight or after hours, if you will. Earnings announcements, monthly jobs report, geopolitical events, any number of things can cause the markets to move. They generally move on low volume. So that low volume creates an opportunity. The amateurs tend to chase it, and they'll trade in the direction of the opening gap because they get very excited about the news. But if you watch, that opening gap will often retrace back, 70% of the time actually, it'll retrace back to the prior day's close. That's called filling the gap, and that's the technique that I identified that I followed and started trading a long time ago. And it's a well-known technique. I didn't identify it by any means. It's been known by Wall Street and many funds for many years. What are the alerts based on? The alerts are based on rules for trading my research. So that checklist that I mentioned that I've used for many years, essentially we just automated those rules and apply to many different markets. I like to trade the futures indices primarily, but we've applied similar rules, and there's different types of rules too, all kinds of ways to use historical data for trading commodities, ETFs, even stocks. How do you repair an option which has gone in opposite direction, say, but is it called buy, put, or so forth? Sajad or Siddiqui, you're going to have to ask someone else. I tried options and found they were way too complicated. I spent too much time trying to deal with the complexity of the option instead of what was going on with the markets. I just trade futures these days. How do you, sorry, I see Dennis asked a question earlier. How do you overcome fear in trading? Really sorry, Dennis, I missed that question. To me, it's all about seeing the historical results for the strategy, right? What do you fear? If you know a strategy, a typical strategy for me has a 65 to 70% historical win rate and has made 30, 40, 50% more than it's lost historically. If you know that factually, and it's not just one system telling you this, but that's the average for me. For me, I'll have 5 different market systems that are confirming a trade before I pull the trigger. If I have 5 systems telling me that this is a strong historical edge for trading, even though maybe the direction opposite of a big gap and very positive news, to me that gives me confidence, right? So, and then when you get rewarded for that confidence and discipline, you realize it's really not that hard. I will also say this, people that follow my research and our research and what we do here, the ones that still struggle with that, even though they see the historical data, I tell them you're risking too much then. You have not accepted the risk. As we tell people, write the check before you place the trade, meaning mentally assume it's going to be a loss and then be pleasantly surprised when it's a winner about 2 times out of every 3. Martin says your analysis is 100% technical, fundamental, 0%. Absolutely correct. My average trade is in and out the same day. Sometimes we go overnight and hold for a few days with different strategies, but most of our strategies are intraday, taking advantage of short-term, very short-term extremes and trends that are driving the market underneath. So I'm just following the footprints of big money is the way I think about it. I don't worry about earnings. I don't worry about PE ratios, none of that. It's all built into price action. And that's what I've done for more than a decade, and it works. Not the only way to make money, but it works for us, and we've had hundreds of paying subscribers for years. In fact, InvestorQuant used to be called Master the Gap. I had some clients come to me that had made quite a bit of money trading using my research, but just wanting me to expand the approach of what we're doing. I said, that's going to take a ton of money to do it and do it right. We ended up raising money from about 20 clients. So 20 of our long-term clients, it's actually more than that now, have invested money in our business to grow the company, 50,000 or more in most cases. So they would only do that if they believed in our team and our approach. So, and we've worked closely with Duke University's Center for Quantitative Modeling. It's a fabulous center over there with a bunch of super smart nerds, as I call them. I'm a nerd too. My wife calls me a nerd. But quant jocks, quantitative researchers, statisticians. Look, I don't want to overstay my welcome because I know there's someone, believe there's someone behind me, and I really appreciate Renee giving me a few more minutes. So I'm going to wrap it up there. Thank you. Come check us out next Wednesday, September 14th, and Renee and Invest Inspiration. Thank you very, very much. Take care.